Hello, very good evening, team. It's Rob Stewart with you live. If you're watching on the live, if you can see me and hear me, please put a thumbs up and type something in the comments box. If you're watching on the replay, please put something in the comments box. Anyway, team, I'm going to start this evening with a little bit of a rant, a little bit of a Rob rant. Every time I go onto YouTube and see other property commentators, I'm sure everybody's got an agenda about whether they want to see prices go up or down or a market crash, all of that sort of stuff. But everybody keeps talking about nominal house prices and how that crash has not materialized. So all this video, all this content, all this narrative about, oh, look, we're going to get there. Everything's going in the right direction. We're going to crash. We have already seen a massive adjustment in the property market. And to illustrate this, I know I talk about this quite a lot, quite regularly on the lives. I show this chart, constantly charting the inflation adjusted house price value. This is using the nationwide house price index because we are in what is effectively now a stagnant property market. If you look year on year, we're pretty much there about sort of, stationary in a high inflationary environment. This means the real value of our homes has come down. Now, why does this matter? So a lot of people go, Rob, inflationary adjusted house prices don't matter at all, right? We only care about nominal because we paid for it in nominal. And therefore, if we're not losing in nominal, we're not losing at all. But that's not true, right? If the value of our house is being eroded by inflation, okay, we are losing. Lots of people are out there talking about how having cash sitting in a bank account is eroding and you're losing the value of your cash in a high inflationary environment. If we're looking at house prices and the nominal prices are stationary, it's just the same as the price of the pound being stationary in nominal terms, but the value of it gets eroded because as everything else goes up, let's just say, for example, everything else in the world goes up 20%, but house prices stay static, okay, it's devalued your house by 20%. The purchasing power of the equity or the money left in your house has gone down significantly. Yes, I get the argument that is also eroding the debt, but we're now in a high interest rate environment as well. So that debt is much more expensive to service. Okay, so everything is a much more complex picture than just looking at nominal house prices. So it does frustrate me a little bit. Everybody talking about nominal house prices and how it's like, oh, we're not crashing, it's not going down. We've seen such a huge adjustment in real term, and as wage growth goes up and inflation goes up, this is changing the dynamic massively. And by the way, I still think we've got plenty of way to go for nominal house prices to be in the negative as well. Okay, but that's just going to compound the issue. Anyway, good evening to you all. Good evening, Sean. How are you doing? For those of you who are new, welcome. I know we're getting lots of new subscribers every week. Thank you. I appreciate it. We're about to hit 2,000. Please give me a favor, or do me a favor if you're on here right now. I'm looking to get to that 2,000 subscribers as soon as possible. Please give me a like or a thumbs up on this video. To help get there. That would help a lot. And if you are new to the channel, what we do on these live shows is look at the data, the actual data that's coming out, to cut through the headlines, to work out the reality of the situation, to enable us to make better investing decisions in property. That's my aim. So team, without further ado, let's crack on. I don't want to be particularly long, so there's nothing groundbreaking or earth-shattering that I want to talk about today. We haven't had, massive increase or drop in inflation or house prices, right? I want to look at some data that's going on in the background, specifically what's going on with the economy. I haven't talked about the economy for a while. Let's see some of the leading indicators as well as the lagging indicators, what's going on there, because the economy and the property market are intrinsically linked. They're very symbiotic. I want to pull out something that I noticed today, actually. There's a massive contradiction in some of the data that's out there, and it's trying to work out what's actually going on with the data that we see in official figures, the data we see in ONS, versus the reality of the shop floor. There's just something not quite tying up to me. And that, inevitably, what we're seeing with some people's agendas is now contrasting with other people's agendas. And we're seeing big, sort of differences on the spectrum of where agendas are with the figures, the data, or the headlines that's being put out there, right? So let's look at what's actually going on with some new build data. And then I want to run through Zoopla, which I'm actually becoming quite fond of Zoopla's house price index. It's not really a house price index. It's almost a forecasting model. It's almost a forward-looking indicator rather than a lagging indicator, the Zoopla HPI. But I'm fast becoming very fond of it in terms of the data it's giving us. So I'm going to go through those three things. Let's start with the state of the economy. And I want to sort of clarify why this is important. Why do we care about the economy when we're looking at house prices? I've shown this graphic, this slide, a few times. It's this symbiotic relationship between the housing market and the economy as a whole. One goes down, it generally drags the other with it. We've got this cycle. Let's just assume house prices fall. House prices fall, everybody has perception of a fall in wealth, confidence, right? Therefore, they spend less, therefore GDP falls, therefore house prices, and it goes around in a spiral, okay? So if there's two things that are completely in lockstep with each other, it's economy and house prices. Now, of course, with interest rates going up, what effectively is being done is forcing us into a brief reset, a brief recession, really. That's why we want the interest rates to go up, to control inflation, bring that inflation down. So by definition, doing that to the economy is going to do that to house prices, or doing that to house prices is going to do that to the economy. So it's important to understand where we are with this. So I saw this graphic a couple of days ago, and to me, it's probably the best leading indicator we've seen for a while on where the direction, the trajectory of UK businesses are, and therefore the economy. And you can see from this, if I zoom out, just so you know, the red line is manufacturing, the green line is services. We're predominantly services based in this country, and the purple line is composite. So purple is tracking most closely with the services. But you can see really, I would say, looking at this, that's probably, we had a little sort of peak end of Q1 this year, and since then we've been sliding. Now it's difficult to this graph doesn't actually tell me exactly what the scale is, but it does say a value more than 50 indicates expansion, so therefore a value less than 50 by default must be effectively contraction. So we're now seeing that the UK composite line here, so that's, you know, everything, manufacturing, services, UK businesses, are in contraction, and that appears to be the trend line right now. So are we now seeing, after however many, you know, millions of interest rate rises we've had concurrently, I lose track of where we are with that, are they now starting to take effect? Are they now starting to bite? And because we are not finished with the interest rate rising yet, how far is this going to go? I think they say that a raise in interest rate generally is felt 12 to 18 months in the future. So we are now starting to feel that start of the interest rate tightening cycle. We're still going up. So if you follow this through, you feel this trend will continue into 2024, potentially into 2025. Okay, so if we're now going into recession, looking at this, by the way, you can see the narrative at the top. It says, it said the reading raised the risks of a recession in the second half of 2023. Well, we're kind of almost 3/4 of the way through now. Incredibly, we're certainly 2/3 of the way through today. So more people now looking at, are we going to go into recession rather than avoid it? What's going to happen over this quarter or the next quarter and in the first half of 2024? We'll keep an eye on that. This same sort of this same data set gave us the house prices. This is looking at the nationwide and the Halifax. When we chart them together, we can see both of them in negative territory. Relate that to interest rates. Fine, interest rates still going up, house prices going down. We know that there's nothing new here. I just wanted to show all the data sets in this particular piece of narrative. Interestingly, contrasting with that, we've got the wage growth at record high. So you can see the purple line here is nominal wage, but the red line is the inflation adjusted wage. And for effectively the last 12 months, I've been saying on this channel that the real wages are decreasing, right? We're getting poorer inflation adjusted. That is now reversing. I think there's a little bit of a lag in the data here, because last week or the week before I showed a graph where we're actually now parity. Inflation-based wages wages are now in pace with inflation. As inflation comes down, this strong wage growth is going to start to increase wages in real terms. And this is probably the biggest headache that the Bank of England have got when they're looking at the direction for interest rates. Okay, if the wage growth is strong, it means people's purchasing power is strong, which means, you know, technically this is like economic theory, right? People have more money, they're going to go and spend it. When they spend it, they're going to heat the economy. Okay, that's going to create more inflationary issues, and the inflation is not going to go away. They want the inflation to go away for obvious reasons, right? So that is a real issue for the bank. However, and this is what I mean about we've got so many contradictions going on right now. So we've got strong wage growth. Only now are we getting into real term wage growth. But if we look at the consumer spending, okay, monthly change in retail sales volume has flatlined since mid-21, okay? Or yeah, mid-21, pretty much flatlined. Little dip now, but it's kind of up, down, couple of percent, you know, -1, +1, -1, +1. this inflation is not people going out and spending loads of money. Retail sales has flatlined. So people's wages growing for the last 18 months has been real terms decline. We're just not going out and spending stuff. So all these inflationary considerations are clearly coming from other places, although are they now embedded? Let's just look at the consumer confidence index. Since the beginning of this year, it's been going up. We're now down ticking again. So interestingly, because there's been a lot of talk in the press about from some narratives, indices, house price indices, narratives of mortgage rates have peaked, they're coming down, soft landing. You look at the actual data, it's looking a little bit more negative, if I'm totally honest with you. Okay, let's look at the next data set. We've got core inflation stays high. This is just a recap here, team. Red line is core inflation. Purple line is overall CPI. That red sticky line, combine that with the strong wage growth, again, is indicating that those interest rates are going to stay higher for longer. Why do we care? Higher interest rates for longer is widening the gap between people, the amount of people coming off cheap fixed rate debt, okay, effectively, the amount of people that are coming off, and therefore the amount of money they're spending on their interest payments on their mortgages every single month, right? So we're getting more people come off, going on to higher rate interest rates, and every month is getting higher and higher and higher, even though that's not now feeding into mortgage interest rates because of swap rates, but that gap is still growing. So there's still, for the next 18 months, I didn't actually realize how many people are still coming off in 2024. I knew the peak was in 2023. However, we've still got over 100,000, I think it's 111,000 people on average for the next 18 months coming off cheap fixed rate debt. And this is just going to take so long to filter through, right? And these interest rates, even though they, the mortgage rates may have come down from just over 6 to just under 6, it's still 3-4 times more than people were paying, right? So this is just going to get worse and worse and worse. Okay, finally, let's have a look at the UK economy lagging behind everybody else, basically, right? And if we look at this black line, this is us, the UK, down at the bottom. The horizontal axis of this graph is effectively Q4 2019, so the quarter before we went into COVID. We are only now just getting back. We're still minus 2% versus Q4 2019, right? We are the only pretty much developed nation out of this data set where we've got France, we've got Canada, we've got Germany, we've got Japan, we've got States, we've got Italy. We are the laggards, right? The UK are the laggards. Why? What has happened in the UK? We can talk about Brexit, we can talk about bad policy making, but all of this is feeding in to an economy that for me is not looking rosy. Okay, yes, we keep talking about avoiding recession. If we look at this next graph, right, of what's actually going on in the economy, this is month by month rather than quarter by quarter. Definition of a recession is 2 consecutive quarters of negative growth, and we're sort of flip-flopping month. So we're not getting those 2 successive quarters, but we could just as well, right? If we just reorder this a little bit, we're very much sideways with maybe a very slight overall drop right now. It's not healthy, and that is going to feed into the property market, I'm absolutely sure. Let me know your thoughts on that with the economy. Where do you, team, think that the economy is headed over the rest of 2023 and into the first half of 2024? Do you see recession coming in the next quarter? Do you see recession coming in 2024? Does it matter? A lot of this stuff seems to just be made up anyway these days. Employment figures, GDP, we can sort of massage it as much as we can. Sorry, I've just come off the slides. Let me go back onto them. Let me know your thoughts. Get it in the comments box. Right. Let's move on swiftly to these new build houses. So I want to ask you, team, some advice on this, and I want to know your thoughts on it, because I was going to start with this slide. Just last week, I went through the UK HPI, the latest ONS figures for UK House Price Index, where there was not a surprise. We were expecting it, but a little tick up in terms of average house prices, up, I think, 0.7% overall. But when I dived into the detail, we saw quite a big skew between new build and existing resold property in terms of average price movement, right? So new build went up monthly change 1.1%, but what I found extraordinary was that the new build index annual change was 19.3% year on year in this month's UK HPI data, 19.3%. So I was hypothesizing about where has this skew come from, because I just refuse to believe that house prices, that new builds are going up 20% year on year, right? Just refuse to believe it. When you actually dive into the small print on this month's data, they did say that they've changed the methodology for recording new build sales, mainly because of the additional time lag, right, that they take to put a new build property onto the register. And if you follow that through, if the new build sales are taking longer than everything else to be registered, bearing in mind, other properties, normal properties could take, and this is after completion, could take 2 months, potentially even more, to actually hit land registry. Does that mean new builds are taking 3, 4, 5 months after completion to hit land registry? And therefore, are we seeing the surge of people going to new build at the end of Help to Buy, right before Help to Buy ended, where the last completions had to be in by, I believe it was the end of March this year? So is that data showing that surge of people taking advantage of Help to Buy? Regardless, I don't believe that figure. And then when you look at the headlines, we've got these headlines coming through at the moment. These are both out today. House builders are stuck with expensive new homes they cannot sell. A crisis is coming. So the number of completed sales will hit its lowest level since 2012. So that's not good news for house builders. And then when we look at another article from another publication, UK house builders shares fall amid fastest drop in asking prices in 5 years. So on the one hand, we got the ONS data saying new builds over the last year are 20% year on year up. And then the following week, we got news articles saying that new build house builders are stuck with expensive properties they can't sell, and share prices are plummeting. So let's just have a look at the share prices. I've gone for share prices over the last 6 months. Bellway, is kind of -3%, not particularly bad. Crest Nicholson, as mentioned in the article, -26.5% share price over the last 6 months. Persimmon, another major house builder, -26.5% over the last 6 months. House builders' share prices are being clobbered right now. And in fact, when I looked at all of them, I looked through all of them this morning, if you look month on month, they're all in the red right now. Yet the ONS says new build house prices up 20%, right? Contradictions and definitely agendas here with selective data sets being put out somewhere. I'm just trying to follow it through rationally. Incidentally, what's your thoughts on that, by the way, team? I'm going to go to the comments in just a second. I saw Moving Home with Charlie on his channel last week, was talking about the state of the economy and mentioned the amount of, I believe it was on Friday, he said something like 4,000 construction firms have gone under in the last 12 months. I think that was a stat he came out with. I can't verify that. Maybe somebody wants to verify that for me. And he was asking the question, why have so many gone under so quickly? Whereas when you look at the last financial crisis, 2008, it took sort of years for that sort of level of construction companies to go under. I have a theory behind that, by the way. And it's kind of, let's link it with these house builders and just house builders in general. And I have an insight into this being in construction, owning a scaffold company. And therefore, when I'm not in my property head, I'm in my construction side of the business. And what we've seen several clients that we've worked with go under over the last 6 months. For various reasons. One was just pure director fraud, but another couple of the smaller builders are struggling because they locked into packages, JCT contracts and prices, either pre-COVID or soon after COVID, with developers, for example. And then we saw this massive spike in commodity prices, massive spike in material prices, even massive spike in the labor prices we're seeing now with that sort of strong wage growth. And in the construction industry, there is certainly a massive imbalance in the supply of skilled labor to the demand. So there's way more demand in construction than there is supply. It makes it very difficult to get the right people in at the right price because the skilled labor is pretty much dictating. So how that has filtered through to a lot of certainly smaller contractors is they're stuck onto prices, and they've tried to go into developments or deals on certain prices, and they've been destroyed with their margins being eroded with the increase in materials and labor. And I feel that is putting a lot of strain on undercapitalized construction companies, main contractors, even potentially developers who are doing things themselves. working subbies themselves, so not on fixed rate, JCT contracts. That's all going to feed into the system, and it's a really fascinating piece of analysis that I think we should all bear in mind, is the actual cost to build anything right now. With property prices potentially coming down, but we've still got huge cost of materials and labour, we're seeing those margins for developers. And when I say developers, I don't just mean the Bellways, the Persimmons, the Barratts. We've got loads of small developers who'll do, sort of 5 to 10 building schemes, even commercial conversions, even just, renovations. Last new build I did, we did the build itself at £110 per square foot. I know 2 years later, that was 2019, by the way. So that was 2018 and 2019, pre-COVID, £110 a square foot, just for the build, not for all the rest, peripheries, utilities, all that sort of stuff, just for the build. I now know people who are doing extensions at £200 a square foot, right? So almost twice the price 2-3 years on from that. That is going to filter in to making it very difficult to add the margins in some of these developments. I think that will filter into the property market over the next year as well. Right. So that's my interesting contradiction between the new build. Before I go on to the Zoopla HPI and see where we are, I would like just to go for some questions. We've got loads of questions. Sorry, apologies, team. I've not been answering the questions. Let me go through some of them now. Just excuse me a minute while I put the glasses on. Yeah, Tom says new builds are fudging their numbers by giving discounts. I totally agree, Tom, and I think they'll give discounts or they give incentives. So these figures that are coming through from the new builds are very often just wrong, right? They're just not representative. And that, to me, I said it last week or the week before when I did UK HPI, that I think there's some skewing of the data here that's making the figures look quite look wrong. Sean, until we solve the issue of wealth inequality, the economy will continue to decline. The wealthy can only spend so much. The middle class are disappearing. Wealth needs to be taxed effectively. Interesting, Sean. I know you saw the video I put out the other day on that rebalancing, using that foundation report, Peaked Interest, which is a think tank put out a report. If anybody hasn't seen the video, I'd recommend you go and see it, where it talks about the long-term impact on interest rates. And if they continue to go up, how actually that will rebalance somewhat wealth inequality and create, rather than the wealthy getting wealthier due to huge passive income gains, there'll be a rebalancing and people have to be more active in making their wealth. So just people sitting on assets which get inflated over the last 40 years, that's pretty much where most people have made their wealth, passive gains. Interest rates going up, which is now bucking the trend of 40 years worth of declining global interest rates. If we're now in a higher interest rate environment, that's going to put downward pressure on the asset prices. It is going to rebalance that somewhat. To what extent, we'll have to wait and see. We could have a black swan event right next year where interest rates are back down at 0.1%. We just don't know. What else we got? Stafford. Hey, Stafford, how you doing? Should have built affordable housing. Do we really need a million new homes? I don't think we do need a million new homes, Stafford. It's another interesting contradiction about the housing market that everybody talks about. UK housing pricing will continue to go up because of supply and demand imbalance. Absolute rubbish, right? UK housing market will go up if people can borrow. So if interest rates are low, people can borrow more, it goes up. When you look at the figures, and again, I've done a video on this as well with that argument. I'm not saying there are not localized supply-demand issues. One of them, by the way, is the rental market right now, where we're seeing a total skew in supply-demand. But in terms of the actual amount of properties, yes, there will be an impact. If we build 1 million, it will make an impact on housing prices, but not nearly as much as people think. I believe the stat is right now we've got 700,000 empty properties in the UK. There you go. Go figure. Perfect. Right. Sorry. I'll get back to the comments, guys. I need to go on with Zoopla HPI. Let's take those off so I can look not quite so geeky. Right. This is recently out, and as I said, I find Zoopla HPI more of a forward-looking indicator rather than the others, which are lagging indicators. So they come up with lovely data sets, well presented. I recommend everybody goes and reads the Zoopla HPI. I like it. I like the modelling that they do. Now, if we have a look at our supply demand that Zoopla are talking about, these boxes relate to the average this year in relation to the average of the last 5 years. Okay, so it's the 4 weeks, the 20th of August, compared to the same period over the previous 5 years. So it does incorporate, yes, COVID, but also the good years of 21, 22, the pretty average years of 18, 19. Demand, 34% down. That's a massive, massive statistical significance. 34% reduction in demand is huge. 20% reduction in the number of sales agreed, a huge, significant statistical significance, right? These are big figures in terms of percentages. Flow of new supply, interestingly, is down as well. That's flow of new supply. Stock of homes for sale, up 16%. Right, so what that means to me, okay, is with less supply but the stock going up, things are sitting on the market for a lot longer, which is interesting because the Rightmove index that we looked at a couple of weeks ago showed no difference, no change in terms of the amount of supply. There was a little tiny uptick on the amount of stock that agents have on their books, which means it's taking longer to sell. But the time to sell on Rightmove has been flatlined for about 6 months. Surely with this, if we have a negative new flow of supply, but the stock of homes for sale is up, there must be a bottleneck somewhere. Things are not selling. And number of sales agreed minus 20% does indicate that. And I'm, for whatever reason, more inclined to believe these stats than Rightmove because they just feel more representative to what's going on the shop floor. I say what's going on the shop floor. I'm active every day, looking at properties, viewing properties, speaking to vendors, and my gut feeling is that all the data that comes out from things like Rightmove, UK, ONS is so laggy or so incorrect. It's just not representing what's going on with the amount of price reductions we're seeing, the amount of motivated sellers we're seeing. People are now becoming much more sort of wise to the situation. But again, I'm down south in a fairly high value area. So many properties being listed, not moving, sticking. With landlords, I think have probably got unreasonable expectations. Anyway, huge drop in demand, drop in sales, but the fact that we're not seeing a huge influx in supply is cushioning nominal price drops. If this supply, this new flow of supply that's at 9%, right? If that flip-flopped and we went to 9%, so an 18% skew, we're going to see prices come down much more quickly. I said it a couple of weeks ago, I feel the whole market is just paralyzing right now, right? It's just all freezing up. Nobody's doing anything. And, this is different to 2008. It's different to the early 90s where loads of people were being made redundant. Unemployment was going up. We're not there. We're not in that situation. And that's what's holding it up. If people don't need to move, they don't have to. There isn't the motivation right now to sell quickly and cheaply for people because banks are being told not to step in and repossess. This is all just kicking it down the line. And it's why I've said for many months now that we're not going to have a sharp drop. We're going to have a slow, steady decline as this all filters through the system, right? There's enough cushioning factors there to keep it from crashing, if you like. But it will continue to decline. Slow and steady is my thoughts. What else does Zoopla talk about? The annual price falls. Again, even agenda. Annual price falls concentrated in southern England. Yes, this is annual price fall. But if you look across the board, we're talking percentages here, right? Everything's come down from 10% annual growth, to the best we've now got is Scotland at 1.7% annual growth. They will probably continue to come down. Funny old thing, in the south, southeast, southwest, London and eastern, we're seeing the biggest price falls because, of course, that's where the highest value properties are. So people who've leveraged more, have the biggest debt, are going to be more quickly affected by interest rate rises than people with smaller debts, right? It figures, that's no surprise. I like this graph. I thought this chart was fascinating. This is a chart of per area, so not just around the country, but per area, mortgage repayment versus average rent. And I think what we're seeing is we're seeing migration in our country, right? We're seeing people are moving potentially, and Zoopla make a good comment on this, from those expensive areas where rents are horrific, but you can't buy with a mortgage because of interest rates anymore, to where the value is in the country, which is seeing that migration from North and Midlands to Wales, South and Midlands to Wales and North, okay? So that line that's in the middle, buying is cheaper than renting. We've got Scotland, North East, North West, Northern Ireland, Yorkshire and Humber, and Wales. And then renting cheaper than buying, West Midlands, East Midlands, South West, Eastern, South East, and London. So basically, if you're above that line, it makes more sense to go and buy, regardless of what the interest rates, because the rents are going up so much. And I think we're now something like 12% annual increase in rents. It's a real crisis that I feel is developing here. And I say that, again, with the contradiction as a landlord with a significant property portfolio and lots of tenants where rents are going up, and our rents are going up. Now we have a lot of institutional tenants, housing associations, councils, where, you know, I kind of feel less bad with that going up because it's the council, it's central government, not central, it's local government probably ultimately paying for that, rather than the end user, the end tenant. But they are going up significantly. But it cannot continue like this, right? Because this is going to create a humanitarian issue at some point if rents just keep going on up and up. But what it is doing is forcing people above that line to go out and try and buy a house, whether it's Bank of Mum and Dad, whether it's taking a mortgage to 40 years, whether it's scraping together anything, whether it's relocating from down south to up north to be able to get more affordability. So we're seeing a big demographical change right now. And Zoopla kind of, in fact, before we get to that, last couple of things from Zoopla HPI. Incredibly, 2023, they estimate the transactions significantly below the 50-year average. And it's looking at this graph for this year, only barely more than the bottom of the financial crash in 2009, and less than 2020 when COVID hit and shut our economy down for basically 3 or 4 months, right? We're going to have less transactions in 2020, almost as little as 2008 and 2009. Which I find quite amazing, and again, I think reinforces that narrative that everything's just freezing right now. What is happening is we are adjusting that house price to earnings ratio, and this is, at the beginning when I had my little rant about this graph, which is inflation adjusted house prices, right, where house prices are coming down inflation wise, wages going up means it's going to be a rebalance of that house price to affordability. So when we talked about that wealth divide, we talked about the interest rates going up, and putting gravity on asset prices. If they're putting gravity on real asset prices, and everybody, when you look at the reports about this, it always talks about real asset prices because that's the actual thing that matters with this. With the gravity on real asset prices making them smaller, people's nominal wages going up, right? The affordability is getting better for people. This is a good thing because this means we are slowly readjusting. People are having it. Don't get me wrong, we've still got a long way to go. But Zoopla is saying we are, as a UK, I think it's saying we're about 6.2 or something, which it was considerably lower than I thought it was. So right now, the house price to earnings ratio in the UK as a whole is about 6.2 times, I think. And you can see here that actually we're below where we were at that peak in 2007. So they are adjusting. And again, this is softening it for people and making it more affordable. I think it's a good thing, right? I do. I really think it's a good thing. Let's just see a couple of things that Zoopla commented on. 2 things. 1, landlords are particularly being squeezed by higher mortgage rates. Okay. Interestingly, they've done some analysis that says buy-to-let investors in southern England now need to have equity of 40 to 50% of the property's value to get the numbers to stack. So that means there's not going to be a lot of people down south doing buy-to-let investments. It's going to be difficult to build that value in as a momentum investor. It's going to be the privilege of people who've held property for a while as their equity's gone up. Okay, so that's interesting. And then the second thing they said was the flexible working supports first-time buyer sales. And just to read this, when it comes to first-time buyers, we expect fewer to buy in 2023, but numbers will hold up to an extent. Flexible working gives them options to buy in cheaper markets where buying costs are cheaper than renting. And again, that to me is talking about this narrative that we're almost seeing migration happen in this country. And this flexible working, I think, also feeds into things like the employment data or the unemployment data. That we're on a different playing field now to the stats that people were talking about 10, 20, 30 years ago. It's a very different time. Unemployment now, 4% now is completely different to 4% in the 90s, I would suggest, in terms of things like unemployment, because there's a lot more people on flexi work, a lot more people on gig economy, all of that sort of stuff. But again, and look, we're going to hammer this home, landlords are squeezed by higher mortgage rates. I just want to recover what I talked about last week. This is the arrears and repossessions data for Q2, where we're seeing that teal line that's starting to go slightly parabolic is the amount of landlords in more than 2.5% arrears brackets, or 2.5% to 5% arrears brackets. Significant increase. What's that? That is 126% year on year, 41% quarter on quarter of buy-to-let landlords that have fallen in to arrears of 2.5% on their mortgage. Landlords are being squeezed. Okay. How do we get around that as a landlord? We need to be able to do two things. We need to be able to generate momentum. We need to be able to create cash flow. We need to have property cash flow multipliers. We need to exceed by a significant amount a normal buy-to-let style return to make property work right now. If you'll excuse me, team, I would like just to put a little plug in for white paper, totally free. There's a link to this in the description to the live. Please go and download it. It talks about how you can invest in UK property right now and get away from all of these. Doesn't matter what the market's doing, okay? It doesn't matter what interest rates are doing, because it's mitigated with both of those. There are certain strategies that are working really well right now. Most strategies that people have been doing for the last 10, 15 years, which are not, okay? Go and download it, have a read. It's totally free. Awesome. Whew. I'll pass over for questions, my friends, and have a look at what everybody's got to say. Was that some useful data, useful analysis? What's going on last week? I wanted to get this in. I know it's the end of August today. Tomorrow, I'd imagine we'll have nationwide HPI out. They usually come out on the first of the month. So I'll be interested to see what's going on with HPI. Nationwide's HPI. Next week, we'll have Halifax's. So on next week's live, we'll probably look at the figures and data behind the latest nationwide and Halifax HPI. Okay, so let's see what we've got here. Tom, I find it frustrating. Buyer power is down 20 to 30%, yet I can offer that decrease on a house without being laughed at. Yeah, I get it. I hear you, Tom. Robin, Barrett sells 604 homes, 168 million deal. What we are seeing with these big house builders, by the way, is they're doing deals with the institutions for build to rent. Build to rent? Yeah, build to rent, which is when we get these big institutions coming in, buying sites or blocks, banks, pension funds, they're not looking for 2 up, 2 downs, one at a time in a row somewhere, right? They're looking for either big sites in one deal, like a whole site of Barrett homes, right? Or whatever, or a big block that they're going to build. So I think it's interesting that seems to be an exit for some of these new builds. Maybe they're selling them. That could actually be an interesting thing. It's just kind of sparked a thought there. So when the institutions for build to rent are buying stuff, they do things on very different yield basis, very different yield criteria to, I would say, the average private investor. So right now, most private investors probably want to be going out looking at properties that are giving them 10% plus gross yield. I mean, I don't particularly care about gross yield. It's all about return on capital. But let's just go simplistic, 10% gross yield, which previously they're probably looking for 8. So over the last 6 months, investors' expectations have aligned from sub 10% to plus 10%, maybe even 12% plus, right? So that pool of property is getting smaller that you can do that with. So more people looking at the same pool. Institutions don't need 10% plus, right? They need 4%. They need 3.5% yields. So what that means they can do, if you sort of follow through commercial valuation and yield-based valuations, is it means an institution, a pension fund, whatever, can come and buy a massive block or a site of new build homes at a much higher price than a private investor or a private buyer would be able to do. And so I suspect what the new build guys are doing are building these things at a particular yield, particular margin, and then selling them on in lot with a lower yield, higher valuation to the institutions. Maybe something's happening. I think that's interesting. Is this just August versus last 5-year average? Isn't August a slow month though? Is August? Sorry, I think that question has come from about the Zoopla HPI. It's August. It's the same 4 weeks based on the average of that same 4 weeks for the last 5 years, if that makes sense. So it's the same 4 weeks of every year for the last 5 years is what it's comparing against. It's not comparing against everything for the whole year. For the last 5 years, it's that 4 week period, same one for the last 5 years. So it's a like for like comparison. Brilliant. Lloyd's. Oh, sorry, Robin, I missed some of your comments there. Lloyd's Bank mopping up lots of new builds to rent out. This could be scaled. That's Robin. I think you've just said what I commented on. So I agree. I agree with you completely, my friend. I agree with you completely. Lovely. Right. Any more, team? I didn't want to go too long today. I've still managed to go 40 minutes. Let me know if you've got any more questions. If that was useful, give me a thumbs up, give me a comment. Please feel free to subscribe if you're new to the channel. Hopefully it makes you have more informed investment decisions. From my point of view, our pipelines are growing all the time at the moment. I'm going to share some of this stuff with you. We're full in sorting out one of the properties we bought about a month ago now in Chester. There were some lease some tenancy issues we had to sort out, and some lease and commercial issues we had to sort out, which we obviously knew about. That's why I could buy it cheap. Sort those out. Valuation is going to go up. I'll walk you through that in a dedicated video. We're appraising some other really cool, exciting deals right now, actually. Again, funny old thing, they are up north. So that's where the yields are. So we're very much investing for yield. Much more difficult to get it down here. Down south. I live just outside of Southampton, so it's much more difficult to find it. Not impossible. I've got clients who are finding things, but you have to add a lot more value to do that. Cool. Let's just see. There we go. I think that's it. Team, it's been an absolute pleasure. I hope you enjoy what hopefully is going to be some nice weather over the weekend. It'd be nice to have an Indian summer. It feels like, I feel for the kids who have seem to have had their summer wiped out. I've got five at home right now, so that's a good handful. It's raining, but looking good tomorrow. So fingers crossed next week we'll get some good weather. Have a good weekend, and I'll see you next week.